Hello everyone, welcome to today's US Open live webinar. It is Thursday, July 27th. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. We have a lot to talk about, from central banks to big tech earnings. So please read carefully through the risk warnings and the disclaimers so that we can get right to it. Once again, please go over the risk warnings and the disclaimers carefully, and bear in mind that anything discussed here does not constitute investment advice and should not be taken as such. Okay, let's get the ball rolling. As I said, we have a lot to talk about. Let's go right to Euro USD. So the US Fed hiked rates yesterday, but still cleared of any guidance. The ECB today also raised rates, but the wording on the statement was softer than previously in terms of what's next. And the BOJ at the Bank of Japan follows tomorrow. The Magnificent Seven posted strong results this week, with Microsoft and Alphabet on Tuesday, and Meta overnight impressed. Meta Platforms, Facebook partner Meta Platforms. On the data front, we had quite a few data. Also, US preliminary Q2 GDP came in much better than expected at 2.4%, higher than the Q1 final. And yesterday, Australian inflation in Q2 moderated further. But let's go right to Euro USD and talk about the two policy decisions we saw from the Fed and the ECB, and starting from the latter, which was just earlier today. The pair, of course, drops after the ECB decision because it did raise rates by 25 basis points as widely expected, but softened the wording around the policy outlook, and now said that the governing council's future decisions will ensure that ECB interest rates will be set at sufficiently restrictive levels. And that's a bit softer, small change, but towards a more dovish direction, because the previous one actually said will be brought to level sufficient. It's a bit more strong, I would say. And of course, President Lagarde said that essentially gave no guidance. She said that the ECB may hike and might hold. Both could be the next steps over coming meetings. Touting here again, data dependent, so no guidance whatsoever there. Yesterday, the Fed had also raised rates as expected, and also kept all options on the table for September, in the most, let's say, uncertain decision of the year. Now, Chair Powell said that both a hike and a hold are possible in September, so we now see quite similar data-dependent, no guidance approach by both central bankers, whereas we used to have a much more hawkish and much more aggressive ECB President Lagarde. Now, she still speaks, President Lagarde, so we don't know what she will say next, but from what we hear now, it's the most dovish thing we have heard, because as I said, we used to have strong hints of more hikes. And in fact, it seemed to be that President Lagarde was a little bit irritated by some of the questions. Maybe it was a contentious meeting, and I'm pretty sure that she would prefer to be able to give some direction as to what is coming next. Now, as we said, as a result, the pair drops, but and essentially the policy differential that we used to have in that favor Euro USD may not be there anymore. But despite of what was said, the ECB still has more ground to cover on inflation, and headline and core were both at 5.5%, much higher than what we see in the US. And in fact, the stickier core actually ticked up in the last print. So definitely more ground to cover. And even though they said that they could either pause or hike, chances that there are still good chances that we need to hike more. And of course, on the other hand, there is also the economic slowdown in Europe, which adds another twist, as it may prevent more hikes if these things work. Pull high inflation and economic slowdown, pull the ECB in different directions. Now, it's hard to approach the pair technically here, but given these developments and this drop we see now, there's definitely a clear risk for further downsides towards the region that we have highlighted before, which is at around 1086, 1078, but sustained weakness past these levels may not be easy, but we still need to see and assess everything that we will have heard by the ECB after the press conference is over. And of course, there are also more key data points coming up. Now, as long as it stays above the EMA 200, the black line on the chart, there is room for 2023 highs at 1.1276, but where we stand now, anything more has definitely a higher degree of difficulty. But again, it's hard to assess the pair technically at this stage. Now, let's go to the Aussie versus the US dollar, and let me bring that chart up. Here we are. So Australian inflation eased further in the second quarter as yesterday's data showed to 6% year-over-year headline, which sent the pair lower. The RBA had paused again in the last meeting as inflation has passed its peak, according to the bank. And although it kept the door open to more tightening, yesterday's CPI report probably gives them leeway to hold again, with the next decision coming up next week. And we'll talk a little bit more about it on the what's ahead section along with everything else. Now, the Aussie rose after the Fed decision overnight, but faces difficulties again today, given this policy differential. It defends the 200-period DMA, which keeps the June highs in play at 0.69, but will cost us around further strength that would bring the 0.7158 resistance in the spotlight. It's hard to envision much strength for the Aussie since the RBA may have reached its peak. Now, above the 200-period EMA immediate bias is on the upside, but the pair is not having a good second half of July. There is risk for lower lows and below, of course, the 200-period EMA, but a strong catalyst would be required for the June lows to come into question, which are located at 0.6563. Now, we only have a minute until the US Open, so let's talk about the NAS 100, the tech-heavy index, and of course a little bit about the latest results from Meta Platforms, which were released overnight. And of course, you can find in-depth analysis both for Meta and from Tuesday's Alphabet and Microsoft, written content on the FXCM market analysis websites of your respective regions. Now let's bring NAS 100 on our screens. Here we are. So the tech-heavy index had an initial mixed reaction to Wednesday's Fed decision, but makes a strong showing today as Chair Powell kept all options open and markets view yesterday's hike as the last of the cycle and expecting rate cuts next year as early as in Q1. More to it, they liked Meta results overnight as the Magnificent Seven this week have provided mostly encouraging results so far. Just in a nutshell about Meta, the social media giant posted double-digit revenue growth for the first time since Q4 2021 as the ad business continued to improve and the cost-cutting measures are apparently working. Furthermore, the firm talked a lot about artificial intelligence and how it already leverages this technology in its services. Now, in terms of the National 100 technical outlook, nothing has changed here. It's on track to take 16K out, but new record highs may prove elusive in the near term. Pullbacks are likely, but likely to be limited by the 200-period DMA, which sits at around 15,140, and strong catalyst would be needed for a breach. We don't see anything at this stage that could undermine the rally, but there are still key data that we expect, and let's go to that. We'll start with the Bank of Japan, which is due on Friday. Governor Ueda has generally put cold water to expectations for policy normalization via a change or a drop of the yield curve control. While a Reuters poll suggested that no change, most of the participants there seen no change. However, inflation ticked up in the recent print, and despite being off its peaks, there is expectation for an upgrade in the 2023 projection, in the current fiscal year projection, actually. There is also the issue of the weak yen, with USD JPY close to the September 2022 intervention levels. So definitely a lot riding there as well. Now, in terms of the United States, we expect the June PCE inflation report. The previous figures had shown a moderation mostly in the headline figure at 4.6%. Core was stickier at 3.8. It's the other way around. Core at 4.6 and 3.8 for the headline, the lower figure being the headline. Now, the more recent June CPI showed significant deceleration in headline and notable moderation in core, but Powell sort of downplayed that down, saying it's just one reading, but definitely key data point that could determine the trajectory of both the US dollar and Wall Street, and of course the bond market. Now, moving into next week, we have Eurozone preliminary inflation and Q2 GDP on Monday. We already talked a little bit about that. And then on Tuesday, we have the RBA rate decision. Again, we already talked about that. The soft CPI report could facilitate another hold. Of course, earnings continue. Ford stands out today and more coming up in the next week. That is pretty much it from me. Thank you for joining me. We'll talk again next week on Tuesday at our usual time, 10 minutes before Wall Street opens.